Joining us now is Jennifer Nason, Global Chairman of Investment Banking at JPMorgan. JPMorgan was the lead underwriter of recent IPOs, Viking Holdings and Astera Labs. She joins me here on set. It's so great to have you back. Thanks for being here.
Thank you for having me back.
There's a lot to talk about, but let's start with what you're seeing in the IPO market, given the fact that we have seen some more names go public. We've got another one, a Chinese company that's going to price tomorrow. And even just today, I'm not going to get into the earnings specifically with you, but some of the class of 2023 reporting results today and sort of casting a light on that opening that we did see last fall with ARM, Klaviyo, and Instacart.
Yeah, and I was watching in the green room as all the earnings broke. So, yes, in fact, I think you and I sat down together in the fall just as those IPOs had happened, and I was very hopeful that we'd see an opening of the IPO market. So we are seeing an opening. It's a little slower than I would have liked to have seen. But the good news is that first class of IPOs has traded pretty well, and Klaviyo is now up today on those earnings. So as an asset class, IPOs have done pretty well. So that's good. Investors will feel very good about that. But now I feel we're in this second wave where we had the big names, well telegraphed, a lot of investor education, priced well. They had cornerstone investors. It was all very sort of staged for success last year. Now we've opened the aperture a bit. So now we're seeing some mid-cap names, not as familiar names to a lot of people. Investors are now willing to consider a broader mix. Do I still need profitability? Sure. But am I willing to wait or see it on the horizon? Maybe. Do I want a little more growth? Maybe. Do I need a cornerstone investor? Probably not. So we're just seeing that aperture widen, and we're hopeful that during the course of 24 that aperture will just open and open, and hopefully by 25 we're seeing an IPO market that feels more back to normal.
What does back to normal actually look like? And I ask that because we've been comparing what we've been seeing in the IPO market for the past 2 years to 2021. That was not normal.
No, that was crazy. That was not normal. So my definition of normal is that the market is willing to consider really any company in the IPO market that's priced correctly. So you can be a slower growth or no growth, but a returning capital story. You can be a high growth, highly revenue generative company, willing to think of everything, but it's just got to be priced correctly. Last year, for a big part of last year, investors only wanted to see one type of company. Had to be big, at scale, profitable, so they weren't willing to listen to other stories. So my definition of a normal market is a willingness to consider pretty much all stories, but drive at pricing.
Okay. And when we're talking about exit strategies, obviously we've started to see this pickup in deal making as well. That's something you and I talked about last fall too. Yep. M&A activity starting to increase. What are you seeing in terms of that right now, as we have seen some larger deals start to get announced, even as the regulatory backdrop is arguably a little uncertain here? Yeah,
and some of those deals like HPE and Juniper, IBM did a deal recently, really by the names to some extent taking advantage of the big tech names being off the field for regulatory. They're searching for assets. So M&A right now is a slog. Every deal is difficult. Things take a very long time. Things are often highly structured. A lot of things are dying at the finish line over diligence issues or, concern about price that's been struck. So it is really hard, but a lot of things are happening. And I'm hoping that as the market continues to sort of settle down, that we'll see less things failing at the finish line, which is really what we're seeing a lot of right now.
And we just heard from Bill McDermott of ServiceNow, Jensen Huang of NVIDIA, really talking about kind of the first mover advantage in this new era of AI. How much is AI spurring deal making? How much of it is encompassing the conversations you are having with your clients right now?
So it's everything right now. So this is the dilemma for a lot of companies as they look at assets. So AI is happening at a pace that I think most people don't appreciate. So you can't afford to stand still. So you might be nervous about the price you're paying for assets or nervous about the investment, just the organic investment you have to make. But the risk is if you're too cautious, you're going to miss the wave or fail to build that sustainable comparative advantage. So that is a big challenge. And you mentioned at the beginning here about capital allocation. So that's really, to me, one of the big stories right now. So if you're Google announcing a dividend, Meta announcing a dividend, part of this is to educate your shareholders that they can't just view the value prop as sort of one-dimensional. They need to understand that there's a lot of investment going on. It's going to be choppy as we see the early stages of this AI revolution. And so they're offering investors a variety of ways in which to make their return. It can't be one-dimensional anymore. And if you're a company that has been very formulaic about capital allocation, so you know how much they're going to spend on dividends, buybacks, organic investment, and so forth, and M&A, then you want to create some degrees of freedom to adjust that formula. Nobody wants to be trapped with investors thinking everything's the same quarter after quarter and I know how I get my return. Everybody needs degrees of freedom in which to operate right now. So capital allocation has become a big story and we're spending a lot of time with clients on that subject. It's good old corporate finance 101 in my book.